real estate doesn't care about the economy, doesn't care about interest rates, doesn't care about jobs. It cares about supply and demand. So that's what you always have to look at, supply and demand. Now, interest rates affect demand because if things are more expensive, fewer people can afford them, so the demand goes down. But it also does other things, like, for example, why do we raise interest rates? Well, to battle inflation. What is another name for inflation? Appreciation, right? What goes up when there's inflation? Real estate, right? So there's things pushing up and there's things pushing down, right? And those things kind of offset each other, But you look at like Texas, last year 500,000 people moved to Texas. By the way, 5,000 people moved out of California. So where did they go? I think they went to Texas, right? But yeah, and then there's another 5 or 6 million people, we don't know where they went, but I bet a bunch of them are here too, right? So we have growing demand, right? Interest rates are on a downward trajectory. Exactly where that's going to go, we don't know. And I'm always very reluctant to predict the future. I know the future is going to be different. I don't know exactly what it's going to do. I'm making gross generalizations. Demand is on a upward slope, right? Interest rates are on a downward slope. When interest rates go down, cap rates go down. When cap rates go down, prices go up. Okay, so we have a lot of things pointing towards, if you take the little magic 8-ball and you say, what's going to be happening in the future? It says all signs point to up. But that being said, when you structure a deal, I always say, worst case, best case, most likely case, and ask yourself the question, is this deal structured in a way such that if things go wrong, like interest rates go up or the market goes down, what are you going to do, right? And to me, I always say a deal should never go bad. It should go long, but not bad, right? When Rob said yesterday, we're buying this below replacement value. What is my brain here? Interest rates could go to hell, everything could go to hell, the whole thing could go, and I end up with this thing that's worth more, right, than they bought it for, right? So you can liquidate it and still at least get your principal back, right? But when, a few years ago, people were pitching me these multifamily deals and they're saying, we're buying this thing at top dollar, but that's okay because we're getting a 3% mortgage and in 5 years we're going to sell it. And I'm like, well, wait a minute. In the history of the world, 3%'s never happened before. I don't believe that's going to continue to happen because I don't believe things that never happened before will continue to happen. It was a 1 in a million year thing, right? And so I asked the sponsor, I was like, what are you going to do when interest rates go up to 15%? And the response was, well, that couldn't happen. I'm out, right? The answer needs to be, we've got the ability to extend the loan from the lender to 8 to 15 years or whatever it happens to be. So in other words, if the interest rates go up, we can extend the loan, right, and keep going, right? We took a little less profit to be able to get that extension. And so the deal goes long and I'm good, right? But when they say the whole deal only works if the stars align in a certain way, which you don't know what's going to happen, I'm out.
So come meet us and click on the link in the comments below.